Welcome back to my channel. In this channel, I review companies as a value investor and determine whether I want to buy, hold, or sell a particular stock. In today's video, I'm going to be covering Chegg, symbol CHGG. This is a new generation company that's providing valuable tutoring, information, and overall assistance to students as they go through their high school and college careers. And many of these students are above the age of 25 because a lot of people go back to get other degrees, or some people need to work. So it takes a little longer to get educated. Overall, this is a really valuable service, and the company's grown really well. They have hit a wall, so to speak, on growth recently, and their stock's really tumbled. I looked at the stock and through my process, and I've made a decision on this stock that I'll reveal at the end of this video. I'll go through my process that I use. It's a process that I've developed for myself, and I'll determine a value of Chegg and compare it against the stock price that the company's being sold at. Before I share all that with you, do me a favor and like my video and subscribe to my channel. And please comment on Chegg. Let me know what you think of the company, good or bad. As I look at Chegg, I look at three areas. First is the company. Do I want to be part owner in this company? Do I like their management team? Do I like the industry? Second is the balance sheet. Is it free of a lot of problems? Does it have low debt? And last is the discount. Am I getting a discount on the stock? I'm a value investor. I don't buy stocks at fair value. I don't buy stocks at a premium. I wait for the stock to be discounted, and I'll be determining that. And based on what I get as answers to those questions, I will buy, hold, or sell. So the Chegg business is all about selling subscriptions to people that need assistance in their education. And frankly, the education process is really competitive. And it's pretty incredible how much younger people are learning. I have two sons, they're 19 and 23. And man, I think they're way ahead of where I was at their age. Just the learning process is so much faster, efficient. I would say my kids are studying courses in high school, as an example, that were 2, 3, 4 years ahead of my time. So I think the students are being asked to really take on really difficult courses with really difficult concepts. And now that we have a connected world, we have every person just about has a smartphone. Having access to these types of services is very practical for these students. So Chegg really fills a big need. I think they do an excellent job. They put a lot of science behind it, a very modern way of helping students get to their objectives and the outcomes they're looking for out of their education. So that's great. I'm really behind that. Now, Chegg is AI is either going to be the best thing that ever happened to Chegg or the worst thing that ever happened to Chegg. It's both a big opportunity and a huge threat. Let's talk about AI and how it could impact Chegg. So obviously AI, the promises are that it's just going to be a better way of interacting with large data models, large language models, being able to get answers to questions that you have. And Chegg is in on AI. They're really developing their own artificial intelligence platform. They have it in their investor presentation. I encourage you to read that. I was really impressed. And they really have a good plan to create a new business within Chegg that is going to be a chatbot that uses artificial intelligence that Chegg is going to be developing. And that's based on other companies that evaluate that have an AI strategy. All they really have is an announcement that, hey, we're going to do AI. But few companies have a clear plan like Chegg is showing on their investor presentation. So I encourage you to look at that. It leads me to believe that Chegg, rather than AI being a huge threat to them, they're using the opportunity to create a new business. And they're going to turn this into a great opportunity. And you think about artificial intelligence like search or other applications, the companies that really focus on a particular area and specialize in it and make it better for customers are the ones that win. Chegg is going to focus on making AI for students that need help in whatever course they're in. So I believe that Chegg is going to really capitalize on AI, really serve this particular part of the market and get more subscriptions that are AI related. So I really like their strategy around AI. And that's one of the reasons why I'm really interested in Chegg. So Chegg has really good focus on things that are important to me as an investor. First, they really have a clear strategy of what they want to do. They want to be the best learning platform to assist students, really nice and focused. And as I invest in companies, for example, Airbnb, they do one thing. They do vacation rentals, short-term rentals. They're privately owned. They do that great. And their stock price is just off the charts. It's creating a lot of value for everybody, the customer, the property owner, the stockholder. And I believe this type of focus is a really good thing for Chegg. They know their market. It's a large addressable market. I happen to think that it's very fragmented. You have tutoring centers across the country here in the US. Well, Chegg can kind of really come in and take a good part of that market if they provide a better service that's available to students via their phone or their computer. They're really focused on creating high margin and a lot of free cash flow. That is speaking my language. I love cash flow, so I'm glad that they commented on that. And they really want to manage their balance sheet as well. So very good to see that. I really like the direction. This is kind of my grade on the management team. I think their management team's doing a great job, really focused on bringing great value to the customer and value to the shareholder. So revenue has dipped. If you look at revenues in the quarter that just ended, and you compare it to the same quarter last year, revenues dipped, and year to date, revenues have dipped. So that is a concern. I think that is the cause for the big sell-off. Overall, their profitability is there. Good to see that. I think they need to lean up some more and really be disciplined with expenses and begin to grow again. If they do, that'll be really good for the stock. So it's good to see that Chegg is a young company. They've been growing over the last couple of years, but they are profitable. They have good earnings per share. And I'm going to use the next 4 quarters of earnings per share in my valuation, because I value both on earnings per share and then free cash flows. The PE ratio, if you look at the trailing 12 months, is really low at 9.4. This is an exciting company. The PE, for me, needs to be much higher. I think I'm going to use a higher PE in my valuation. It's also good to see that a young company like Chegg is producing free cash flow. For the first 9 months of 2023, they have solid free cash flow above $100 million. And I'll be using that run rate annualized to determine where my starting point for free cash flow will be on my valuation model. But again, usually companies, it takes a long time for them to produce free cash flow. And Chegg is already doing that. And they've really been publicly traded for 2 to 3 years. They've been around for 4 or 5 years. I believe that Chegg is discounted at 78% based on my valuation of the company. And that's a pretty big discount. I value a company based on free cash flows and earnings per share. I think that each share is really worth about $19 a share, but the stock market will sell you shares for $10.68. Let's take a look at free cash flows and how I value the company based on its free cash flows first. So when I annualize the year-to-date number, I get to $162,000 of free cash flow that I expect Chegg will produce in this year. I'm going to grow those cash flows by just 4%. So it's going to be a very modest growth rate. And then the terminal value will also grow at 4%. That's a very conservative growth rate. These guys can really take off and grow. But since they did hit a flat section to their business, I'm going to keep it at 4. I'm going to use a higher weighted average cost of capital than I would typically do. If you look at their balance sheet, they have negative debt. They have more cash than they do debt. So it's a quality balance sheet. They have the ability to pay off all their debt they wanted to, and they produce solid EBITDA. Even having said that, since they're a small company, I'm going to use a higher weighted average cost of capital to be conservative. The net present value of all those cash flows is $2.2 billion. I'll add the cash, take away the debt to get to an equity value of $2.2 billion. The market cap for the company is about $1 billion. And the stock, I think, is valued at $19.71 based on the free cash flows discounted at today's value. And the stock market will sell you shares at $10.68. So if you look at the cash flows, the stock is discounted 85%. Now let's look at earnings per share. So the next 4 quarters of earnings per share are expected to be at $1.15. I'm going to use a PE of 18, which I think is conservative. I'm willing to go 24, if not higher for Chegg, but let's just go with 18. Growth rate of 3%. And I'll discount the earnings per share that I expect in the future using this formula. And I get to a value of $17.64. Stock price right now is $10.68. So there's a 65% discount using the earnings per share method. I blend the two and I take a higher weight of those free cash flows because I believe in those more than earnings per share. So 2/3 free cash flow, 1/3 earnings per share. And I get to a blended discount of 78% on Chegg. Looking at where the stock has been over the last 12 months, boy, a big drop from the height down to where it's at today. Year to date, it's down 56%. But I'm a value investor. I love picking up companies that have been left for dead, that aren't, popular anymore, that are being, scrutinized, that bad news is around them. Because when you show me free cash flows and you show me profits, I see value. And the market has recognized it. The stock is up 24% in the last month. So it still has more value left, I believe, between the current stock price and the stock price it's trading at today. So should I buy more shares of Chegg? Well, let's take a look. Starting with the company. What do I think of the company, the management team, the industry? I really like all of the above. I like the business. I like that they're reinventing a lot of things in the education area. I think students are benefiting from it. So I think there's a lot of value being created for students. And I really like their management team as well as the industry. I think their balance sheet's in great shape. They have more cash than they do debt, and they produce really good EBITDA. So they're well below 3 times EBITDA, and they provide a really nice discount. So I am a buyer of Chegg stock. Thank you for watching the video. I hope you found it interesting. I'd love to hear your thoughts on Chegg. Please leave a comment and do me a favor and like my video and subscribe to my channel. Good luck investing. Thanks again for watching.